we're going to spend the next 20 minutes talking about what the election means for policy and why it doesn't matter. Because either way, the US and other Western governments, and China as well, will continue to spend. And then we'll talk about how we see the opportunity set here at Andromeda and what we're doing to navigate and take advantage of this environment of fiscal dominance. So the first question I would like to think about is, why do governments keep spending? What's the alternative for them? And why are they continuing to essentially printing money to finance, very close to record deficits in the post-war period? And we've seen this in the United States, we've seen this in European countries, and also in China. What is the reason why Western governments need to continue to spend? And the reason is that it's really about their survival. We have grown up with the idea that hard work pays off. That going to university, getting education, doing something for yourself in the end is good for the community, and it's good for productivity, but it also means more earnings. In the 1940s and 50s, we had 80% of people that were 18 years old at the time expecting to be richer than their parents. Today, it's 50%. So the American dream, the idea that capitalism and essentially education, work, what we have been doing in the last few decades, in the end pays off. This idea is fading, and essentially the model that the social contract that Western economies gave to their electorates in the post-war period is changing. What is happening then? Well, it's happening. What you see here on the left and right side chart, what's happening is that since the global financial crisis, and also particularly post-COVID, governments in the West have continued to spend to maintain their living standards, even though productivity has stagnated. So even though real wages have stagnated, and even though young people don't have anymore the expectation to be richer than their parents. And this obviously results into an increasing and ever-growing pile of public debt. The allocation of wealth has also changed. So essentially what you see here on the next slide is that obviously productivity has stagnated, productivity has come down across the West, but also growth has become more and more uneven. So the bottom 20% of the population has not really benefited, versus the top has really benefited from quantitative easing, and essentially the rich have gotten richer in a way with policies that have rewarded asset prices. Now, why is this all important? Well, we are at a record for corporate profits, which are nearly 14% of GDP. They used to be 6% in the early 1900s. Yes, there have been periods where corporate profits were also a high level of GDP, but at the same time, we also have wages which are in the low 40s, and they used to be at 50% of GDP. So there's a combination of social inequality where the bottom 99%, the bottom 90% of the population has remained, has not taken party, has not been invited to the party, essentially, to the monetary party and the fiscal party of the last decade, and corporates have done better. So it's true both between large firms and small firms, as well as between the top 1% or the top 10% and the bottom 90% of the population. These are two sides of the same coin. Large firms versus small firms. Large firms have done much better, small firms have not. And the wealthier households have done better, and the least wealthy households have done worse. This is important because the history of politics and also the history of economics tells us that when we have periods of high inequality, typically, people vote for radical change. There is a very interesting book on this, which is called The Economics of Populism by Dornbush and Edwards, and it does analyze the political events in Latin America in the 60s, in the 70s, in the 80s. It's a very good blueprint for some of the things that have happened in the West, in Europe, for example, with Greece, with Italy, and the US with the first Trump administration. As inequality grows, productivity stagnates, real incomes don't grow, the social contract of the capitalist system based on competition, based on hard work paying off, essentially is fading, and people want solutions, and sometimes they vote for extreme solutions, and that explains the popularity of populist candidates. But it also explains why governments continue to spend, because there is very high domestic inequality, and it cannot be solved very easily unless you engage in structural reforms, which are really painful. The paradox, however, is that the solutions that have been implemented recently are actually making inequality worse. Quantitative easing has rewarded asset owners, but the withdrawal of monetary policy that we have seen recently, which was mostly about higher interest rates in the front end, has also made inequality worse, because obviously people with fewer assets, which are the bottom 20% that you see on the left, are also the people that have more floating rate debt. Small firms, which are also weaker from a cost bargaining perspective and a bargaining power perspective, they're also the ones that borrow the most with loans, versus larger firms borrow more with long-term fixed income instruments. So the sequencing of policy normalization that the Fed has implemented, raising rates by 5%, has actually hurt the bottom quartile of the population even more. And this is why we have a situation tonight and tomorrow where we're very head-to-head with the Vice President Harris and Donald Trump. But what we want to highlight is that, yes, there are policy differences between the two, but the reality is that probably they will both have to spend. There is a lot of pessimism. There's a lot of people that are upset. And even in a scenario where Kamala Harris wins, probably the deficit will be above 7% next year. And geopolitical risk will continue to be high. And that's another reason why, if China is spending, the US needs to spend, and Europe needs to spend as well. So we're in a different regime. We're in a situation where the Fed is doing its part. The Fed is being very dovish, but without an imminent recession risk. And as we said, the 50 bips cut that they've done is probably a lot at this stage. It's been too much. But more importantly, when we turn from this period of pause, where policy essentially stopped into the election, when we go into next year, what will take front stage is again fiscal. And so we're going back to fiscal dominance. Monetary has done its part. We think the Fed has done too much already. We're going into fiscal dominance, and both candidates will spend. This is a collection of estimates across different think tanks that we have put together. And you can see that spending and tax breaks are going to be very large, whether it's Harris or Trump. What will change is where the revenue will come from. Obviously, Harris will plan to increase corporate taxes. She will be more balanced. She will probably not do anything about unrealized capital gains, which was discussed earlier on. Donald Trump will use tariffs, so will essentially redistribute capital from outside the US back into the US, and that would be even a bigger boost for domestic corporates. But the size of the budget is large in both cases, and we can delve into the differences and the differences between the two. But the reality, the message that we want to give you is we're really here going from a year where volatility has been really low, apart from some summer events, but it's been relatively low. We've talked a lot about monetary during the year. The focus has been on the Fed. Inflation has been coming down. There's been this immaculate disinflation. But right now, we're going back to focusing on fiscal policy, and fiscal policy is going to be big. It's going to continue to be big. There's one word that we never mention with our investors and with that you never hear, and that's austerity. There's very little mention of spending cuts, and that's particularly true in the US, but also true in other parts of the world. And China is also going to respond to US spending in a very tense geopolitical environment. So we're talking about a shift We're talking about a shift in narrative, but also a shift in policy since the beginning of next year. And again, we'll talk about what our model is saying. As you remember, in one of our previous webcasts with investors, we talked about a high probability of Trump in our model. That probability is still there. Our model is still leaning towards a Trump victory, but it is very head-to-head. And then we'll talk about the opportunity set in the market based on what we see, not just about the election result, but what we see in the coming months, how we see this shift in fiscal dominance, what it means with in terms of inflation, in terms of interest rates. So I'm going to give the ball to Tao, who is our head of research from Singapore. She's crunched the numbers tirelessly on elections, and this is the latest results of our adjusted model, and then Tao will also talk about the basic model and what it means for tomorrow.
Yeah, thank you, Alberto. And as Alberto was explaining, our model currently is showing a higher probability for Trump. So in our methodology, we basically look at all the polls from all the states, and we run 10,000 simulations for each state, and we so as to compute the distribution of electoral college votes, and we compile the overall probability of who is likely to become the president. So in the model, if we use the polls equally, we treat each poll equally, and we don't do any adjustment, the result is really showing a 50-50 toss-up. However, in our base case model, we actually weigh the poll by the quality of the poll based on the past accuracy, the past potential biases, and then we adjust for potential bias against Trump. And this came to the slide you are seeing just now, where we are thinking our model is suggesting around 60% probability for Trump versus 40% for Harris. And as you can see here, our model has been showing the higher probability for Trump for quite some time, since early October. And in our model, there are several states which are the most important ones, of course, the swing states. And within the swing states, we are really looking at Pennsylvania and Nevada. So based on the latest polls, we can see that Harris seems to be leading in Michigan and Wisconsin. However, if she wants to secure more than 270 electoral college votes to win the overall presidency, she has to get Pennsylvania. There is almost no chance for her to win without Pennsylvania. And currently, Trump is having a slight lead in Pennsylvania. And then if we go to the next page, and if we look at the balance of power in the House and in the Senate, our model currently is showing a slightly higher probability for the Democrats to take the House, around 65%. And on the other hand, for the Senate, it is highly likely to go to the Republican. And putting all this together, it still shows the overall probability of a Republican sweep is quite substantial if you take the presidential race, the House race, and Senate race together. And currently, it is around a quarter of a probability for the overall balance of power to be a Republican sweep, which is quite substantial. And now I will pass on to my colleague Eddie to talk about our market views and also the implications and the trade implications.
Thanks, Tao. So if we just take a step back and if we re-highlight the point Alberto made at the start, both candidates have one thing in common, which is that they will eventually want to stimulate. So this is a regime of fiscal dominance. It's likely that with the US, other countries will follow suit to not be left behind. An example of this more recently has been China. So after 6 months of the market discounting the probability of China's stimulus, what we've effectively seen over the last few weeks is an increasingly supportive Chinese government towards stimulus. And in the last round of stimulus that the Chinese government gave, the market was a bit disappointed, but we effectively look at this as a perspective of China thinking about fiscal stimulus almost in response in some ways to the US election. Put differently, following the US election result, we think we could see more, we see additional fiscal stimulus coming from China over the coming weeks, depending on many ways the election result. Now, following China, we also expect to see, additional stimulus in Europe, albeit it might take a bit of time. But effectively, what we're seeing at this stage is a global resurgence of fiscal stimulus following the US election. Now, what does that effectively mean? When we think about the bond market reaction over the last few weeks, we've seen a re-increase in rates. But what's interesting about it is that the rate rise has been more than the increase in inflation. Now, our base case for inflation, both in the US as well as in Europe, is for inflation to, in our base case, to stay the same or to increase more likely, depending on an oil scenario. But when we think about sort of the increase in rates in the last few weeks, especially in the US, it's outperformed the inflation expectations, outperformed the inflation swaps. What effectively that means is we're entering in some ways a new dynamic in the fixed income market, specifically the rates, where the market is pricing in an increasingly likely fiscal dominance scenario, increasingly likely a probability of higher fiscal spending. Now, what is a higher rates regime environment effectively mean? We will see in many ways an increase in dispersion. We'll also likely see an increase in defaults. Now, in our models, both for US and Europe, we're expecting a modest rise in default, in the rate of default, a little bit more in the US than in Europe, but effectively a small increase, which is a good environment effectively for an increase in dispersion, an increase in trading through alpha opportunities, both on the longs and the shorts. And when we think about the market overall, we're at relatively tight levels at the overall index level, at overall rate level. So real rates have come down from the peak. And as we're also seeing in credit spreads overall, especially in IG credit spreads are pretty tight. But this, as we said before, is a good environment for increasing alpha opportunities on the longs and the shorts. I'll now hand back to Alberto to talk about our overall construction.
Yeah, I mean, essentially, we're in a situation where the market has, priced in a lot of easing. The Fed has gone full dovish without an emergency. It's been an emergency move without an emergency, that 50 bip rate cut. And obviously, the labor market has recovered afterwards. And besides the hurricane-driven weakness, we still have a pretty solid labor market. We are definitely much more worried about a right tail event than a left tail event in the future, because all this robustness that we've seen in the labor market has actually happened in the context of a bridge loan, a pause in the economy, a bump in the economy, during which the Fed has given a bridge loan to companies. And now that fiscal comes back, now that there is more policy certainty, then investment can recover, capex can recover, companies can make long-term decisions and hiring decisions. Again, it's really hard to see a deterioration with less policy uncertainty post-elections. We might have a few days of election uncertainty on the results, but after the policy path is clearer, it will be much easier for risk takers in the economy to make hiring decisions and to make capex decisions. So you can imagine that those numbers in the labor market might do better. And so what are we doing? How do we think about the opportunity set in fixed income at Andromeda right here in an environment where we have still very sticky inflation, still high rates, so the all-in yields are interesting, but we have tight spreads. We probably are going to have some volatility, especially if Donald Trump wins. We probably are going to have more dispersion across sectors. There's going to be a lot of sector alpha to be captured in the future. So how do we think about the opportunity set? I mean, we have a lot of specific trades that we could talk about, but I'm going to just summarize 3 thematic traits that we are thinking about and why. The conclusion is very clear. We've got domestic inequality. The capitalist system somehow has failed, has not succeeded as much as people thought. So people are disappointed, and we need reforms. We need better growth, better productivity. Inequality is a result of capitalism between success and failure, and the success needs to be rewarded. But here people are probably feeling like they lack opportunity. Also, geopolitical risk is very high. And as a result of that, there is a race to spend and a race to compete in the sphere of geopolitics, whether it's the Middle East, whether it's Taiwan or Eastern Europe. Governments will have to keep spending. And the deficits are going to be high, whether it's Kamala Harris or Donald Trump winning the elections. There will be a different composition from revenues and expenditure. We could talk about it for a while. Obviously, Kamala Harris will be a little bit heavier on corporates and will spend more in the bottom part of the population with handouts, and Donald Trump will be heavier on foreign countries with tariffs, which might backfire later on and create more inflation. And the corporate tax cuts will benefit, everyone, but particularly the higher earning corporates. What does fiscal dominance mean? Well, it means that ultimately supply of government bonds are going to be higher, and we've seen already the long end of rates going wider, much wider than in a normal Fed cutting cycle. This is because this cutting cycle is not a cutting cycle that comes in a recession or with an emergency. It's a cutting cycle that was preemptive. So we might see more of the long end going wider, especially in a Republican win, especially in a Republican sweep, which we think the market is underestimating. And we have it at over 20% probability. So the long end moving wider means that duration can be volatile, but also that fixed income markets as a whole can be volatile. But it also means that the spreads that you're getting in credit right now might be maybe a little bit tight for across the market for the risk that you're taking in buying credit. So what do we like right now? It's three things. We like to have special situations and idiosyncratic credits that have catalysts for their specific improvements, or what we call credit alpha, both on the long and the short side. We like to go into sectors that are unloved, sectors that can do well with inflation. And we have been looking at energy, we've been looking at banks, and we've been looking at industrials that have been particularly unloved in Europe. It is very easy to be in credit, but it's not easy to be in the right parts of credit right now at this stage in the cycle. The other thing that we continue to like is convertible debt, especially convertibles that have a spread component that the typical convertible investor would not look at. So convertibles that have an option, and particularly when it comes down to companies that are companies that can pass on costs to consumers and customers. So companies that are in the energy space, banks, of course, but also in the industrial space, companies that have pricing power. And then finally, growth-linked assets. If you find bonds that have that are linked to GDP performance of a country, then that's something that will do well even with inflation, the nominal GDP performance. And here a large example is Ukraine. Ukraine has restructured its capital structure and has issued two series of bonds. One of the series are bonds that are linked to the GDP performance of the country. So these are new bonds that started with very low price and have very good convexity, can appreciate a lot. And Ukraine will probably have a ceasefire, whether it's Donald Trump or Kamala Harris at some point next year. So that's something that has a catalyst. So in our process, we always think about convexity, upside and downside. We want to have something that's it's not just scary, but we want the convexity to be positive. And in credit, that's a little harder right now as a market level, but we do think that credit is better than govies and better than duration. And we've seen large institutional inflows going from treasuries and OATs and BTPs into credit. So, but we like to be selective in credit. We like convertibles that give you upside, and then we like growth-linked assets. Ultimately, governments will continue to spend. Fiscal dominance means steeper curves and some volatility, but it also means that central banks will have to make the choice between price stability and financial stability, and ultimately they will prefer to keep yield curves in check. The biggest fear central bankers have is losing control of the long end, and the long end drives risk. And if you lose control of the long end, then you have a situation where you have a tantrum like the UK in 2022. They don't want that. So in the end, they will try to control and cap the long end and guide the long end. And that will mean that ultimately FX will be the loser. So nominal currencies in developed markets will be potentially sacrificed for spending. And that's why you want to have returns that are much bigger than treasuries. You want to have credit, you want to have double-digit returns, and you want to have things that are linked to real assets, not just to paper assets. So you want to have bonds, but you want to have things that have also a real asset upside link. And you want to be nimble. So right now, this is how we are positioned. We have convexity to the upside. We also have some convexity to the downside. And we're prepared for, we're obviously prepared for nothing happens. We'll still do well because we have idiosyncratic alpha. But if there are swings in the policy cycle and in the rates markets, and then as a result in the credit markets, we're prepared to capture that. So with that, we are at half an hour. Happy to take questions. Please write them in the chat. We already see a couple of questions in the chat, but feel free to write them down. And happy to answer your questions, and also happy to follow up later on if you want on a bilateral basis on email. We're always around. So I'll just
so I'm going to read out some of the questions have come in bilat. So I think the first question that we have over here is regarding the increase. So, okay, I'll try to group them. It's essentially about the increase in fiscal stimulus globally outside the US. So why do we sort of expect there to be an increase in China and Europe in response to the US?
Yeah, so I think that in Europe, things are more complicated. We have a lot of governments that are flirting with very high debt levels. We continue to see a relatively dovish stance. Europe is struggling. We have all seen the Mario Draghi report about productivity. Europe needs to do a lot more. The paradox that we hear almost is the irony is that a Donald Trump presidency could even wake Europe up faster to be more independent on defense. And in the Draghi report, which is very long, and there's three priorities, which is energy, defense, and then technology. And Europe needs to catch up. So there is definitely an acceleration in that structural spending, even though it might come with a mini crisis. And then there's China. We see the China stimulus as a put option. It's not going to ignite growth, but it might be bigger than we think. And markets were very, very lightly positioned on China. We don't have credit exposure to China because it's mostly very, very low price distressed, and that might not capture the upside. But there are some convertibles in China that are very interesting, so that can capture some of the upside. Happy to take any other questions.
Yeah. So if I'm just going to summarize a few of the other ones. Tao, there's one for you, which I'll come to on the election. The other one is essentially on Ukraine, and to thinking about essentially, under a Trump scenario, there seems to be appetite to accelerate a ceasefire. Should we expect the same under a Kamala victory?
So let's talk first about the Trump scenario. Yeah. So there's been some backdoor negotiations in Ukraine. One of the last headlines that we heard about was essentially an agreement to not hurt the industrial infrastructure, the energy infrastructure ahead of the winter. That's been relatively respected by both parties. And obviously the Western allies and Ukraine itself have opened the door to negotiations. Now it's really about what Russia will do. That's the main factor. And obviously Russia's stance has been to not do anything concrete, not do anything clear prior to US elections, because obviously their strategy, their options would change depending on which candidate is there. But either way, we think that there is a clear willingness from the West to reach a ceasefire agreement by the end of next year. Probably with a Donald Trump victory, it's something that can happen in the first half of next year, and with a Kamala Harris victory, it might happen in the second half of next year. And probably, it would be slightly better for Russia in the first case and slightly worse in the second case. But when you think about the GDP of Ukraine, even taking out some of the eastern territories out of the GDP count, it's a very strong, growing country. It will receive, we estimate, around $500 billion in aid post-elections from the private sector as well. Companies like Ryanair, from Ryanair to Rheinmetall, want to invest. So it's very likely to see not just the country, but the GDP and also the corporates doing well. It's one of the few areas that Europe has to develop to have commodity supply and also workforce supply. Young people, young and educated people coming to the rest of Europe to increase productivity. So it's a vital part of Europe, and we have been involved in EM. There's not many interesting opportunities right now. A lot of things are tied. Ukraine is still pretty interesting right now.
Perfect. Tao, if I can summarize a few of the questions for you, they focus around the U.S. election result. There's sort of two parts to it. One is which are sort of the top states you'd be looking at to get a first gauge on the election result? And then secondly, there have been one or two polls in the last 48 hours, one or two forecasters who've sort of increased their probability of a Kamala victory. Any thoughts there around what they might have done differently relative to our model?
Question. So on the election night, when they start counting results, I think because of the timing, there will be some states which they will know the results earlier, and out of all the swing states, the probably first one we will be knowing will be North Carolina, which is quite an important indicator because currently Trump is leading in the polls. And if they really get a Trump victory for that state, at least they have a good indication the polls are not too far away from the actual results. If we get a Harris victory, then we will start to reassess the probability and think if there is any bias this time against Harris. And after that, the second most important state that will also get results early will be Michigan. And again, it's an important indicator for us to assess against the polls. Currently, Harris is leading in Michigan. So if Harris gets the state, it's still okay. It doesn't mean she's very likely to win, but at least confirms the polls are more or less accurate. But if Trump wins with Michigan, it is probably a very strong indication that the overall race will be in Trump's favor because there is hardly a path for Harris to win without Michigan. And then to the second question in terms of the forecasters, I think one potential issue is maybe they are treating each poll equally. So if you even using our methodology, using our simulations, if we treat each poll equally, we are going to get a 50-50 probability, which is currently a lot of the other models are showing. And to be honest, in the simulations, when you are getting like 50.2 for Harris versus 49.8 for Trump, it is really just toss up, and is hardly able. They are hardly able to say they are actually saying Harris is more likely to win. So it's really not telling us any information. However, in our methodology, they weigh the poll in according to the quality. So the higher quality polls will get a higher weightage, and they also adjust for potential bias against Trump, which we think it is still likely this time. And based on that, currently our model is still showing a higher Trump probability.
Thanks, Tao. So essentially, official polls, no adjustment, 50-50, with the adjustments that we make on quality of polls and the Trump bias or the Harris bias, then it looks more like a 60-40, essentially. And so with that in mind, we also always want to do things that are good in the long run, don't depend on what happens tomorrow. And the reason why we talked about these three ideas, idiosyncratic credit alpha, number one, number two, convertibles, and then Ukraine and growth linked assets, is that they will work medium term regardless of the election outcome. And we strongly believe that after this monetary easing last 12 months, where the Fed started to signal a tilt and then cut rates, we are going to go in a different phase, which is fiscal dominance. It's going to be much more interesting with the long end of rates, with inflation potentially stabilizing and being sticky, and central banks becoming a little bit less interesting, but volatility becoming more interesting. And with the market in mind, with tight spreads in mind, it's a great time to think about convexity, think about lightening up a little bit on beta stuff and focusing a little bit more on alpha. We're here to hear your thoughts. We had a pretty good run until the end of October, and we continue to do well. Happy to discuss with you into your end. Thank you so much for your time. This probably is is going to be, we're going to do one more webcast probably at the end of this year or beginning of next year, but please do reach out for questions and thoughts. to ourselves or to Hope, our head of business development. Thank you so much for your time.